Hey everyone, Jeff here from Profit Invest. Today I just want to talk a little bit around how we create our ultimate ETF portfolio and potentially how that may be diversified, quality, passive investment strategy. Currently, there's a large range of cheap quality ETF products on the market, and building a great investment strategy can be achieved in as little as 1 to 3 holdings these days for a very cheap price. So let's explore our 4 favorite options and see what they provide. So option 1 is putting the all-in-one portfolio and going 100% of your ETF holdings into the Vanguard High Yield Fund. So this method is probably the simplest and one that many passive investors utilize. This method has been made popular in many FIRE communities. It involves solely investing in the Vanguard Diversified High Growth ETF. The best thing about this product is it combines the many of their popular ETF products to create a highly diversified fund across many markets and equities. So in this portfolio, the good is it's a simple, easy investing strategy. You'll get broad international equity allocation and you'll get a massive asset diversification. The bad is you'll get a slightly higher management fees than alternatives. The fund is relatively new, being initiated in 2017 with no number 5 and 10-year performances. However, past performance is not a good indication or reliable indication of future performances. However, it's not completely a passive investment philosophy and contains some defensive assets. So if you're interested in getting in the Vanguard High Yield, we've attached the website up here. So if you just jump across there, quickly jump into Vanguard High Yield, it'll take you to their website. You can see there the fund size is currently at $1 billion. It's domiciled in Australian dollars and it was incepted in 2017. You can see there slightly higher management fee than a lot of other funds that are particularly passive at 0.27. In comparison, VAS I think is around 0.07% per annum, extremely cheap there. And we've got a distribution frequency quarterly. So the Vanguard Diversified High Growth seeks to track the weighted average return of various indices of the underlying funds in which it invests in proportion to the strategic asset allocation before taking into account fees, expenses, and tax. Okay guys, so moving on now to option 2, which is getting some exposure to Australia and the broader world markets. So for this, we're going to look at holding about 40% VAS or equivalent and 60% VGS, which gives us our exposure into the MSCI Index for International Shares ETF. So in this method, it's a focus purely on equities and we are targeting a very broad exposure. In the strategy, we would acquire a portion of low-cost Australian exposure ETF. A good example would be VAS or A200 equivalent. Both of these are very low cost and either would be suitable. We then look to acquire a larger portion of VGS. Now, VGS is an index fund for the world, excluding Australia. Hence our reasoning for combining it with the VAS/A200. VGS is a very low-cost fund and is domiciled in Australia. It has a decent history of returns and has proven to be a good quality investment product. So, in summary, the good here is we'll get broad market exposure to many of the world's financial products. We'll get a reasonable price and it's Australian domiciled. Both of these are well established and we have a drip method available for both. So if you're not sure what a drip is, we'll link a document in the description below. The bad here is we'll get some slightly higher management fees than solely VAS or a VAS IVV method, and manually rebalancing the portfolios may be required. If you're not a fan of China and India, we may get some inappropriate exposure to some economies here. So it's worth keeping that in mind. Once again, the ticker codes for these, and you can find these through your online broker, or if you've got a full service broker, just ask them about that. But the ticker codes here are VAS and VGS. So if you're interested in these, always do your due diligence. We are not financial professionals. Keep that in mind. See a financial professional. But you can see here, VAS was incepted in 2019 has some massive returns over the 1 year, and 10 years 7.6% per annum. VGS, which is the MSCI index tracker, and that's got a 10-year return of a massive 13.5% there. So you can see here the VAS VGS has 40% Australia, 40% US, Japan sitting at 5%, UK at 3.5%, France, Canada 2%, and other is about 8.5%. So moving on now, we're looking at option 3, just going all in on Australia. So this is a very low fee option here. However, it's very focused on Australia, and this may be, you might want to invest in this due to a home bias or a dividend focused income approach. For this method, a low cost ETF would be the most suitable. An example which would be either VAS or A200 or equivalent through, say, a BetaShares, iShares markets. And so the good for this is it's an easy and user-friendly approach. You can make full use of the highly franked distributions, typically paid quarterly. So this is very good for some income investors. We've got no currency risk. It's Australian domiciled. We've got reasonable expense. So this VAS, I think, is a 0.07% management fee. It's one of the lowest cost ETF products in the market. We've got drip opportunities. Once again, if you're not sure what drip is, we'll post a link to what a drip is in the description. A very effective way for income investors to get into the markets. We get no overseas diversification with this method, and we get no exposure to markets with historically greater returns. So VAS, we've got 4.6 billion under management fee of 0.1%, and you're looking at a 10-year yield of 7.6% PA. Next on the list, option 4, we're looking just go solely Australia and the US. So this is obviously very focused. You're not going to get exposure to, say, Chinese markets, European markets, etc. But for this option, we're looking at going 50% VAS or equivalent. You can once again pick up an A200, etc. and 50% IVV. So we'll just quickly jump into IVV over here through BlackRock. IVV's got a very low management fee here of 0.04%, and in the second half of 2018 this fund was converted into an Australian domiciled iShares ETF, which will remove the need to complete a US tax form known as the W8BEN forms. So it's always worth keeping in mind when looking to invest overseas. Check out their rules and regulations. Go see a financial professional, which we are not financial professionals. This is just for entertainment purposes only. However, IVV will get you exposure to a large established US companies for a very low cost base in a single fund. And we typically like to use this here at Profit to diversify internationally, and we seek long-term growth opportunities for our portfolio. And you can see the growth of a hypothetical $10,000 here since inception has grown upwards of $30,000. So massive returns here. So jumping back, so the benefits of doing something like this, going 50% Australia, 50% US, it offers very high franked distributions, domiciled in Australian dollars for a reasonably low expense. Here we're getting some exposure to US markets with excellent previous returns. We're getting some diversification outside of Australia. Both ETFs are well established. It's worth keeping in mind that DRIP is not a feasible option for IVV at current share price and yield for a lot of investors. To do the DRIP, you'd have to have a lot of money invested here, which is potentially not suitable for some investors. And we get no exposure to other markets and developing markets. From time to time, you may have to rebalance your portfolio to get back to that 50-50% split due to the higher returns historically from IVV, and you'll get no exposure to micro cap companies. So once again there, VAS $4.6 billion assets under management, IVV $3.4 billion. Very good 1 year returns here at 23.6 and 30.9%, and we've got 10-year yields of 7.6 PA and a 16.25% PA. So massive returns here for both options here. So once again, if you want some more help finding quality ETFs, be sure to find out our ETF checklist, which we've attached here, that we personally use to find great ETFs. And for help all things investing, check out our ebook here. Once again, it's important to remember that we are not financial professionals. Always see a financial professional or accountant before making any of those decisions. We are not financial professionals, and this video is for educational and entertainment purposes only. Thank you, guys. We'll have another episode next week. Cheers.